What is up, guys? My lions, my people, what's poppin'? Welcome to Stock Market 101. For those of you who are new to the channel, my name is Emiliano Gonzalez, and my goal here is just to share my experiences and knowledge with you guys and hopefully add value to your lives. So before we get into the video, please find the subscribe button down below, like the video, and share with your friends. And now, let's hop into it, guys. What are stocks? Stocks are a type of security that gives stockholders a share of ownership in a company. Stocks are also called equities. Now, what does that actually mean? It means that stocks are basically a part of a company that is sold to the investors or the public in exchange for money. Why do people do this? So companies issue stocks so that they can raise money and then use this money to create new products, expand their business, and pay off debt. While investors or the public, they buy stocks so that they can get money, they can make money. And they do this by receiving either dividends, which I'll explain later on in the video, or by selling their shares once it gets to a higher price. Let's take a quick look at an example. Alright guys, so let's say for example that I own a lemonade stand. I want to raise money so that I can expand my lemonade empire. However, the bank refuses to lend me money because there is too much risk involved, and private investors refuse to lend me money. I have a third option. I can go public. I do this through an IPO, and this allows investors to pay a certain amount of money, like $10, in exchange for a share or part ownership of my lemonade business. Now, let's say my company is doing very well, and the price of my company's stock rises from $10 to $20. The investors can now sell their stock, which they bought at $10, and sell it again for $20 and gain a profit of $10. This is how people make money off of the stock market. IPOs, initial public offerings. What is it? An initial public offering, or IPO as they are commonly referred to, is basically the first time a company issues stock to the public. Like I mentioned before, companies do this in order to raise money for different purposes. Let's take a look at how they do this. So let's take a look at what actually happens in an IPO. What happens, my friends, is that the owner of the company, like me with the lemonade stand business, will go to what is called an investment bank, which I will talk about in another video. From here, based on the value of the company, the investment bank and myself, the owner of the company, will decide the IPO price, the number of shares we will use, and the percentage of ownership of the company that I will give up. Dividends. What are dividends? Before I had said that one of the reasons investors will buy a company stock is because of dividends. So dividends are basically payments made by a company to its shareholders. The reason why companies do this is to show that they're doing so well that they can afford to pay investors back. Not only that, but it creates hype or excitement around the company because it is literally paying its investors money. This makes it more likely for more investors to want to buy the company's stock. Let's take a look at a few examples. Alright guys, so let's say that after the IPO of my lemonade business, I received so much money that I decided to put all the money to research for a new product. After the product launches, it does very well and the company begins to see a lot of profit. That is when I decide to use part of that profit to pay investors in the way of dividends. This in the long run will increase the amount of shareholders in my company, which is good for everybody. Stock market. So the stock market is basically, like I mentioned before, where companies can sell their stock to shareholders, potential shareholders or investors. Now, there are something called stock exchanges. Now, these exchanges are everywhere, and there are a lot of them. But one of the most important ones is the NYSE, or the New York Stock Exchange. It was created in 1792 in New York City on Wall Street. The New York Stock Exchange today is where big companies like Nike, Disney, and ExxonMobil and others trade their stock. Indexes. What are indexes? An index is an indicator or measure of something. In finance, it refers to a statistical measure of change in the securities markets. Now, it is basically a way to track the performance of certain assets. Some of the most commonly used indexes are the S&P 500, which tracks 500 of the biggest companies from both the New York Stock Exchange and the NASDAQ, which is another stock exchange. The Dow, or the Dow Jones Industrial Average, measures the stock performance of the 30th largest companies listed on the stock exchanges in the United States. Greed is good. What do I mean by this? What is the point of all of this? Market, stock, investors. What is this all for? The goal of all of this is to make money. So nowadays, a lot of companies, they have one goal on their mind. And that goal is to make a profit or make money. Basically, what they want to see is the share prices of the stock goes up, up, up. Because nowadays, a lot of the CEO's salary is based on the company's performance, right? So if the company's going up, is making profit, the CEO's salary goes up, executive salaries goes up, right? The whole point of this is to make money. Now, this sometimes comes with consequences, harmful to the employees of the company, individuals, the customers, maybe even society as a whole. But I'm not here to tell you if this is right or wrong. I'm only here to tell you what the facts are and try to enrich your lives with the knowledge that I've gained, my experiences, and let you be the ones to make your own judgment. Alright guys, that concludes today's video. Thank you so much for tuning in. Before you go, help a fellow brother out. Hit that subscribe button, like this video, share with your friends. Until next time, guys.